I was staring at the raw COMEX feed at exactly 1:10 p.m. EST today, watching the bid-ask spreads widen to a point that usually triggers exchange circuit breakers. The numbers flashing on my terminal simply did not make sense within the context of normal market mechanics. Gold didn't just cross the $5,000 threshold, it aggressively punched through to $5,232.79 per ounce. And silver? Silver is sitting at $93.30 an ounce as of this midday Friday session. My coffee went cold hours ago. My stomach actually dropped when I looked at the volume profile and realized what this means for the Sunday night futures open and the inevitable gap up into next week. The mainstream financial media is frantically pumping out headlines right now, trying to box this explosive price action into a neat, easily digestible narrative for retail investors. They are telling you this is purely a geopolitical safe haven reaction. They are aggressively pointing the camera at the third round of U.S.-Iran nuclear talks happening today in Geneva, highlighting the massive U.S. military buildup in the region. They are blaming the sweeping Supreme Court rulings on emergency tariff powers, and the U.S. Trade Representative's shocking new directive to raise the global baseline tariff to a crippling 15%. But that is the illusion. That is the convenient, surface-level narrative designed to keep you focused on the geopolitical theater while the vault doors quietly lock on the actual physical assets. The breaking news is the trigger, yes, but it is not the powder keg. The paper market is losing its absolute grip on physical reality, and the institutions are panicking because the underlying structural math has completely broken down. Welcome to the Capital Nexus. If you want to survive the brutal wealth transfer that is unfolding in real time right now, you need to subscribe immediately. We track the raw, unfiltered data that the institutions are actively trying to suppress, and the window to position yourself outside this fragile paper illusion is violently slamming shut. Let's reconstruct exactly how this trap was set over the last 48 hours, because understanding the timeline is the only way you can see what is coming next week. Thursday morning, the markets were already on edge, anticipating the Geneva talks. But the real institutional panic began when the Supreme Court ruling handed unprecedented emergency tariff powers to the executive branch. Almost instantly, the U.S. Trade Representative signaled the new 15% global baseline tariff. Think about what that actually means. It is a death sentence for globalized, cheap supply chains. It means the immediate, absolute hyperinflation of imported industrial components. The smart money didn't look at equities. They immediately looked at the raw materials required for domestic energy production. They looked at physical commodities. Thursday afternoon, the algorithms began aggressively repricing supply chain risk. But the COMEX paper shorts, the institutional players who routinely dump naked paper contracts to suppress the price of precious metals, tried to step in and cap the rally. They dumped thousands of paper contracts trying to paint the tape red, hoping to trigger retail stop losses. Usually this works. Usually retail gets scared, sells their positions, and the institutions cover their shorts at a profit. But this time, it failed. Friday morning, 9:30 a.m. EST. The equity markets open, and the geopolitical premium from the Geneva talks hits the wire. The U.S. military buildup is confirmed. The paper shorts try to double down, but they hit a brick wall of physical demand. The price of gold refuses to yield, grinding its way up to that staggering $5,232.79 mark. And then the real anomaly occurs. Silver completely detaches from its historical leash. By 1:10 p.m. EST today, silver rockets to $93.30. It is staring down the barrel of $100, a psychological and mathematical barrier that will trigger an absolute avalanche of algorithmic buying once breached. The shorts are trapped. They are bleeding out in real time. The weekend is approaching, and no sane institutional desk wants to hold naked short positions on physical metals over a weekend where Middle Eastern geopolitical tensions could snap, or a new tariff directive could completely paralyze Asian shipping lanes. This Friday close is not just another trading session. It is an institutional bank run on physical metal. Real, gone, multiples. That is what is happening to the physical inventory. It is real, it is gone, and it will soon be priced at multiples of what you see today. We need to zoom deeply into the true structural tension driving this, because what I found deep in today's coverage is a fundamental transition of market power that the financial media is intentionally ignoring. For the last 3 years, the dominant narrative has been that central banks are the undisputed whales driving the precious metals market, and yes, they have been hoarding. But look at the actual numbers from today's data drop. Central bank gold buying actually dropped 21% last year. They fell below the 1,000-ton mark, absorbing exactly 863 tons. The mainstream media is trying to spin this as a bearish signal. Central banks are slowing down, they say. The top is in. Are you kidding me? Look at who stepped into the void. Look at the momentum-chasing exchange-traded funds. The ETFs have completely taken over the driver's seat. They absorbed over 800 tons of gold. The retail and institutional FOMO has finally arrived, and Wall Street is using these ETFs to aggressively front-run the physical shortage. They are perfectly happy to let retail hold the paper ETF shares while the custodians quietly secure the underlying physical bars. The power dynamic has shifted from sovereign accumulation to algorithmic, momentum-driven panic buying. But gold is just the preservation of wealth. Silver is where the systemic math completely falls apart. Let's look at the absolute strongest numerical tension in the market today. Silver is currently facing a massive, terrifying structural supply deficit estimated at exactly 95 million ounces short. 95 million ounces. Let me repeat that so the scale of this truly sinks in. 95 million ounces of physical silver are missing from the supply-demand equation this year. You cannot print silver. You cannot arbitrarily summon it into existence with a Federal Reserve keystroke. This 95 million ounce deficit is not driven by jewelry demand or investors buying coins. It is being violently driven by the unstoppable mandate for green energy. Solar panels, electric vehicle infrastructure, advanced defense technology required for the exact military buildups we are seeing discussed in Geneva today. Every single solar panel requires physical silver paste. Every single EV requires physical silver contacts. The green energy transition is a ravenous, uncompromising machine, and it is draining the global vaults at an unprecedented rate. The paper market has spent decades artificially expanding the supply of silver through leveraged futures contracts. They created a digital illusion of abundance. But the solar panel manufacturers don't want paper contracts. The defense contractors building missile guidance systems don't want paper contracts. They are standing at the COMEX delivery window demanding the physical 1,000-ounce bars, and the bars are simply not there. This is why the gold-to-silver ratio has forcefully compressed down to the 57.0 level. Historically, a ratio of 57.0 implies that silver is dramatically outperforming gold, acting as a slingshot. When gold runs to $5,232.79 and the ratio compresses to 57.0, it fundamentally drags silver up with it. The physical industrial demand is putting an absolute floor on the price, while the geopolitical panic is tearing the roof off. The institutions know this. The commodity trading advisors know this. They are looking at the $93.30 live spot price right now. They are looking at the $100 target for next week, and they are calculating exactly how much fiat currency they are going to have to print to paper over this 95 million ounce crater in the physical supply chain. Here is my core thesis for what happens next, and the exact reason why I am staring at this $93.30 silver print with a knot in my stomach. The institutions are trapped in a mathematical paradox of their own creation, and next week's open is going to force their hand. My thesis is that the paper derivative market for precious metals is on the verge of a catastrophic structural failure, and the $100 silver target is the exact tripwire that will detonate it. When silver officially crosses that triple-digit threshold, the algorithmic margin calls will become self-sustaining. The banks that have spent decades naked shorting silver to suppress the price will be forced to buy back their paper contracts in an environment where physical supply simply does not exist. Remember the numbers we just walked through, 95 million ounces. That is the structural deficit staring the market in the face. 95 million ounces of physical silver are missing. When you have a 95 million ounce deficit colliding with a relentless 15% global baseline tariff that makes importing any raw material exponentially more expensive, you do not just get a price correction, you get a fundamental repricing of physical reality. The momentum ETFs that just absorbed over 800 tons of gold are going to pivot. Once the algorithms realize the gold-to-silver ratio has compressed to 57.0, and that silver is the industrial bottleneck for the entire global defense and energy apparatus, that ETF momentum is going to flood into silver, and the paper market will break, systemic, broken, unfixable. Now, before we look at the exact timeline for how this unfolds over the weekend, I need to make something absolutely clear. This is my opinion. It's not financial advice. Do your own research, understand your own risk tolerance, and never blindly follow anyone on the internet. We have to logically address the downside risks because the institutional market makers are not just going to roll over and hand you their wealth. If they are cornered, they will fight dirty. Over the next few weeks, as silver pushes toward that $100 mark, you are going to see violent, terrifying price drops. You will see red candles on the daily chart that make no logical sense. Do not panic. These are not market corrections. They are institutional shakeouts. They are engineered wealth transfers. The bullion banks will dump thousands of synthetic, unbacked paper contracts onto the COMEX during off-peak hours, usually in the dead of the night, to trigger your stop losses. They want to shake the weak hands out of the market. They want to terrify retail investors into selling their positions so the banks can scoop up the underlying physical assets at a discount before the undeniable repricing occurs. If you understand the structural 95 million ounce deficit, a flash crash in the paper price shouldn't scare you. It should infuriate you because you are seeing the manipulation in broad daylight. But it also means the spring is coiling tighter. The only thing that could invalidate this thesis is if the green energy mandate is entirely abandoned globally and the US military completely halts its technology procurement. Given the third round of US-Iran nuclear talks happening in Geneva today, and the massive military buildup we are witnessing in real time, does a sudden halt in defense manufacturing seem likely to you? Exactly. Let's zoom out aggressively, because what we are witnessing right now, with gold at $5,232.79 and silver at $93.30, is not a mere commodity bull run. It is the terminal phase of a global debt supercycle. For 40 years, the Western financial system has existed in a comfortable illusion. We exported our inflation to Asia, we imported cheap goods, and we suppressed the price of hard assets using financial derivatives. But the Supreme Court ruling on emergency tariff powers and the immediate 15% global baseline tariff directive just killed that era forever. The 15% tariff is the absolute death knell of the deflationary illusion. We are officially transitioning from a unipolar world built on fiat currency trust to a multipolar world built on physical resource dominance. When central banks buy 863 tons of gold in a year, even if it's a 21% drop from their peak panic buying, they are still fundamentally abandoning the US Treasury market. They are mathematically admitting that sovereign debt is no longer a safe haven. They are preparing for a world where the currency you hold is irrelevant if you do not control the physical commodities required to keep your grid running and your borders secure. Gold at $5,232.79 is not a bubble. It is simply the new, terrifying baseline of a dying fiat system. The dollar index isn't just fluctuating, it is losing its geopolitical utility. The BRICS nations and emerging markets are looking at the US-Iran tensions, they are looking at the 15% baseline tariffs, and they are realizing that holding Western paper is a geopolitical liability. This is the great capital rotation. It is the most significant wealth transfer in human history, moving out of leveraged digital illusions and into physical, tangible reality. The institutions know they are out of time. They are using the ETF momentum to front-run the retail public, quietly loading their vaults, while the media distracts you with political theater. They want you holding the bag. They want you trading the paper illusion while they secure the physical reality. But you are here, you are watching the raw data, you are early, you are aware, and you are strategically positioned to front-run the front-runners. As we head into this weekend, keep your eyes locked on the geopolitical wires out of Geneva. If those talks break down, the safe haven demand on Sunday night's futures will be historically violent. Watch the $5,232.79 gold level. Watch the $93.30 silver level. Watch the 57.0 ratio. But most importantly, never forget the 95 million ounce deficit. That is the anchor of reality in a sea of paper lies. Will the COMEX ultimately be forced into cash-settling silver contracts when the vaults run dry? And when the music stops, will you be holding a digital promise or physical weight? Let me know exactly where you stand in the comments below. This is the Capital Nexus. See you in the next one.